inflationary pressure the Indian economy is facing. Now, wholesale inflation rose to a 4-month high in March, climbing to 14.55% as against 13.1% in February. This is largely in the backdrop of surging prices of crude, petroleum and natural gas amid disruption to global supply chains caused by the Russia-Ukraine war. In fact, wholesale inflation, if we look at it in the past 1 year, has nearly doubled. It was 7.89% in March last year. Now, essentially, wholesale inflation is the average prices of goods at the wholesale level, that is commodities that are sold in bulk rather than to retail customers like you and me. But if we look at the retail numbers as well, the retail inflation had also surged to 6.95% in March. That is a 17-month high as food prices accelerated at a record pace. Let me go across to my colleague Hina, who's joining us here on the broadcaster. Hina, if you can take us through the details here, because obviously we've seen the retail inflation also spike. Now we're seeing the wholesale inflation spiking as well.
Well, you know, Avni, last week, in fact, last Saturday, I had gone to buy vegetables for this week, and lemons, for 250 grams of lemons, I had to pay about 60 rupees, and for 1 kg of tomato, I had to pay about 50 rupees. For vegetables, for about 4 days, I had to pay in total 600 rupees, which is about 150 to 200 rupees more than what I used to pay on a regular basis for vegetables of 4 to 5 days for my house. Now, this is inflation. You know, we use these big words like inflation, wholesale inflation, retail inflation. It gets really difficult for people to understand what are we really talking about. So I thought we'll simplify this for our viewers. So this is inflation. The way prices are rising, the pain that we are witnessing every single day when we go out to buy fruits, vegetables, or even fuel for that matter, this is inflation. It is impacting each one of us. And today's data is very, very important. As you were mentioning earlier, the wholesale inflation in the month of March, as released by the government today, suggests that it has risen to 14.55%. With this, for the entire financial year 2021-22, we can say that wholesale inflation has remained in the double digits, and this only tells us the pain of producers, because this gives us a glimpse of how the situation is in the wholesale market. However, in the retail market, from where we buy our vegetables, fruits and other things, etc., on a regular basis, there also the prices are quite high. Now, why is this happening? Why is this inflation so high? It is because of surge in global crude prices, global natural gas prices. So basically, the input cost has gone up, and hence producers, people who make or manufacture things for them, the materials that they use to manufacture their goods and services specifically, that is going up, and that is now being forwarded to the retail consumers, and that's why we are getting impacted. Now, the government says it is because of what's happening between Russia and Ukraine, so nothing immediately can really be done about it, but it is hurting us. And since wholesale inflation in March also remained quite high at about 14.55% at 4-month high, so we can only say that this pain is here to stay for quite some time now.
Absolutely, Hina. Pain is here to stay for quite some time, but it's not just that, because the trouble continues, and even for those who have taken loans, EMIs, the cost of that is also likely to go up. India's largest public sector bank, SBI, has hiked the lending rates by about 10 basis points. That's 0.1% across all loan tenures, and this hike has come into effect from 15th of April. You've seen Kotak Bank also hiking rates. Earlier, Bank of Baroda also hiked rates. Essentially, this is going to be the trend now, more expensive EMIs. That is the other big takeaway here. So, Hina, this is the other big aspect. Not only are people, burdened with the inflationary pressures, every single item is getting more expensive. Now, even their EMIs are going to get expensive.
Well, that's right. And when we say that our EMIs are going to go up, it is going to be for all kind of loans that people have taken, be it home loan, vehicle loan, personal loan, or anything that they have taken from the bank. Now, State Bank of India, India's largest public sector bank, this morning increased the MCLR or marginal cost of lending rate by 10 basis points. And usually, Avni, what happens is that whenever there is an action by SBI, it's usually followed by other banks as well in the country. So, similar sort of action can be expected from other banks as well. Two banks you've already mentioned, Kotak as well as Bank of Baroda. It simply means that our monthly EMIs are going to go up. People who were looking to take home loans or vehicle loans or personal loans will have to now think twice. Now, why this has happened? Again, inflation is to be accused, in fact, to be blamed for this as well, because what is happening between Russia and Ukraine is impacting our economy. It's going to have a significant impact on the growth. And the last monetary policy of the RBI, we saw no change in the interest rates. In fact, during that monetary policy meeting only, the economists were expecting that because of rise in inflation, the RBI should now begin hiking rates. It did not. But banks have now started doing it, and it is just going to get more costlier from here on. So we'll have to see for how long this crisis between Russia and really Ukraine continues, because a lot is now going to depend upon the geopolitical situation, the supply disruptions that are caused by it, which are leading to one, surge in inflation, and second, the surge in our monthly EMIs.
Absolutely, Hina. Thank you so much for taking us through all those details and breaking it down for us as far as the impact of all of this is going to have on all of our pockets. But let's, in fact, bring in some more perspective here. Yuvika Singhal, economist, is joining us, as well as Dr. Shrinu, Professor of Finance and Economics, as well, is here with us. Thank you, both of you, very much for joining in. Let me go across, Yuvika, first to you. In terms of the wholesale inflation numbers that we've seen, of course, we discussed the retail inflation as well last time round, but this also was much higher than what was being expected. What is your own assessment?
So as far as wholesale prices are concerned, I think, yes, there has been a surprise and upside surprise quotient to the number. But if you see, not as much, because over the last 1 year, WPI prices have remained in double digits. And we have seen much stronger inflation as far as input costs are concerned for the entire fiscal year. So in our minds, it's not as much a surprise. But nevertheless, with WPI prices continuing to remain firm and continuing to rise at a much elevated pace, eventually there is bound to be some degree of pass-through that is going to happen. We have seen pass-through happening in the last financial year, but probably not as much. But given that retail prices now have also begun to move up, this pass-through from WPI to CPI should continue and continue to add on to price pressures in FY23. And that is where our concern comes from.
Right. Dr. Shrinu, coming to you here, this is not the end of it, right? Because we are yet to see the entire impact of the price rises that we've seen, especially with regard to global crude prices and the fallout of that, even in the next month.
Yeah. See here, if you are coming into that SBI, this is not first time. It was happening in 2018 also. MCLR lending, it has increased. Major, it had considered basic point to calculation of this. Very important if you want to know that. The trade particularly borrowed to avail to kind of loan to benefit from the RBI rate cut rate, but MCLRI replaced the base rate structure had been operating since which was mentioning July 2010 onward. But here, if you are going to following to that RBI changes to repo and other rate occasionally, but the banks are not quite quick with changing their interest rate as per the RBI rates. So most commercial banks do not change their lending and rate for the customer. Ultimately, the bank customer do not receive the benefit from aimed by the Reserve Bank of India. Until 2016, RBI had been verbally instructed the commercial bank to change their lending rate with every repo rate. But RBI introduced MCLRI for the benefit of the customers. Is the new MCLRI will quick change in the lending rate, and the commercial bank will have to obligate with the RBI fast pace. The repo rate is including the MCLRI rate. See, generally, if you are observing to the two basic thing, MCLR and base rate, the base rate is another concept into banking industry. As far the loan are concerned, the base rate is minimum rate set by the RBI, below which you are following to not allow lending their customers unless there is any government mandate or RBI rule specific that the bank allowed to offer. And how majorly we have to see that how could this increase rate impact on the common man life if you are going into that home loans and car loans. Other, if you have home loans, if you are following into that, very difficulty they have to loan, maybe it will costly. If you are following into that, that MCLRI calculation also, basis of the loan tenure, that is the period borrowed has been repay the loan, the tenure related benchmark and internal nature. Hence the bank determine the actual lending rate by the what we have added into that element spread to that tool, that we have to follow that. The tenure premium will be there. Major factors will be there. Marginal cost of fund and operating cost and negative carry on account of the CRR, mean cash reserve ratio. Occur when the tenure on the CRR balance will be zero, negative carrying rise would be actually written on not more than the cost of the fund. These major things we have to follow, and maybe now that maybe I can say that is an alert to that customers, maybe that which you are loan, maybe it will be costly comparatively existing rate to that present rate. In 2018 also it was happened same thing, but generally when RBI it will change repo rate automatically, they not in written form, verbally they will tell to that commercial bank that you can act according to that your lending point of view, but banks generally they won't follow. But now situation due to all crises, if you are going into Russia, Ukraine and inflation also maybe directly, indirectly, negatively affecting on the that cash inflow, that maybe it is the negative impact.
Right.
And we can say that it is very costly to the particular customers. In that,
Right.
I mean, recently we saw that Bank of Baroda also, it has increased according to the CMLI rate.
Yes, absolutely. In fact, Yuvika, the fact that banks have started increasing their rates before the RBI has, how do you read that aspect? And obviously, now we might see the RBI increasing rates as soon as the next policy.
Right, Avni. So absolutely. So if you look back in this last RBI policy, though we were expecting a hike in the reverse repo rate by 20 basis points, actually the RBI went a step ahead. Not only it, so while it let the reverse repo rate remain where it was, it introduced the standing deposit facility, the SDF, which automatically took the lower bottom of the LAF corridor 40 basis points up. And in a precursor to that, we had seen RBI in a phase where they were tightening liquidity. They were taking out liquidity from the system. And at the shorter end of the markets, the shorter term rates had moved up very much close to the repo rate. And in this process, in a calibrated process, first through by withdrawal of liquidity and then affecting the SDF rate, which came as a corridor, a bottom corridor to the LAF, the width of the LAF window, in some sense has made the cost of borrowing for banks expensive. So it is rate tightening by stealth, if we could say so, although they have not touched the reverse repo rate. So in this scenario, and looking at where inflation is, our own expectation for inflation in FY23, we peg it in a range of 6.1 to 6.3. So that is likely to be higher than RBI's upper band of inflation threshold. So keeping these two factors in mind, a rate tightening cycle is definitely on the cards. It could begin as early as June or August. In our sense, we are looking at a base case scenario of 50 basis points hike in the repo rate. It could be as much as 75 basis points also. We do not rule that out, but still, for now, we are sticking to a 50 basis points base case scenario. So in this kind of a situation where inflation is rising, where banks know that RBI is going to begin on a very obvious rate tightening cycle, beginning as early as probably the next meeting, they are preempting a rise in cost of funds, which they are wanting to pass on to the borrowers. And mind you, when you look at inflation, there are three parts to it largely. So what stems from food, fuel, which we essentially call the non-core components of inflation. And then there is core inflation, which is largely the demand side of inflation. Now, theoretically, when you look at three components of inflation, there is little that Reserve Bank or any central bank can do as far as food and fuel are concerned. Fuel is largely exogenous to India because we are a net importer of crude, so we are price takers. Even as far as food is concerned, this time around, the price pressures that we are facing in food, largely on the front of cereals or whether it's cattle feed or edible oils, are largely stemming from global factors, which we have little control over. And to ensure that these price pressures do not become generalized in the economy, the Reserve Bank has to increase the cost of lending. And coming from that, it's the core side of the inflation, which is the demand side of the inflation that the RBI can control. And by making these loans, whether it's a housing loan or a vehicle loan, they can attempt to curb some part of the demand side inflation that is running in the economy, which could have greater legs going into FY23, because as the economy opens up, vaccination gains pace, hope the new variant that we are talking about is probably benign. We could see a very short-term impact or probably a minimal impact. And if that is bound to happen, demand side pressures in the economy could have remained elevated. So this is one way of controlling what RBI can control, and that is the demand side of inflation to some extent.
Yes, absolutely. In fact, thank you so much, both of you, for joining us and giving us your perspective.